Hey guys, so another week has come through, and holiday shortened, but today was still tradable, at least until into the last hour before the market shut down for the holiday weekend on the futures. So last week was a emergency repair or adding a new data stream from Tasty, and I went through some of the brief details of the differences between the Tasty feed and the Schwab feed, and that's kind of where we left it. And this week was I decided to do some cleanup of the UI a little bit. I wanted to get the data feeds more visible and in a consistent spot, and kind of lock this down because I do like it. What spawned the need for another data feed was that I noticed now that I'm starting to use the application during the day alongside my trading platform to make trades, so I want to see the data and then get some kind of signals generating off of this app to where I have more confidence in making the trades that I'm starting to make. And it's also the research platform. And when I was noticing that I was not getting updates on the chart rapidly enough, and then it got to the point where when I was trying to bug fix it, and it's like, okay, I don't care if the data I'm getting in is not live because it's showing up as being delayed. I want to see that candle update, and so we kind of, the AI made some code changes to where it would display that candle, that live candle forming, and I could see the updates. And I changed colors and everything to where I could see the candle. It was with Schwab, it was steadily going back and back and back, and that was a very volatile week. And with the volatility, I guess Schwab has, as an enterprise, only so much bandwidth, and that bandwidth was being tested. So we know if we have a market meltdown, it's going to be very hard. If you have accounts at Schwab, it's going to be very hard to get out of your positions, probably. Because this wasn't like 2008 or 2020 COVID. Times in history where there's so much activity in the market that you literally couldn't even log into your broker to get in or out of trades. And we're not there, but this is just showing you that they do base investment on this stuff, on this infrastructure, and we're starting to see the results of that minimal investment in the infrastructure. And so as the days progress, and it happens during the day, even on what you would consider just like normal days. This week, maybe volume was a little bit higher than normal, but it wasn't like out of this world normal. But even during the day, after the morning session, Schwab is behind, and it will literally take it almost all day. I'm not losing any data. It's just it's so delayed. It's not useful for live needs. Tasty, it too at these times suffers, and its path will get degraded. But the Tasty, that DX feed that it's using, is it transmits about twice a second versus the Schwab once a second aggregation. And there are differences on how Tasty aggregates the data. So there's a little bit more information in the Tasty feed. We'll go into it later on. But it does catch up quicker, and so it gets back to more live. And we'll kind of go over some of the research that I've been started to do the past couple of days. Now that I've got this stabilized, I've got the data feed stabilized. I've got two data feeds now, and I've got two sources of information. That those two sources of information carry slight differences in it, and because of the slight differences, I can get some improvement, and then based on the two, we can start analyzing the information, the signals that they each generate, because the feed data are different enough that the information and the information it may generate for you will be a little bit different, and having two that agree, get you closer to a drift. Because we're trying to not pay for a live tick feed, because those can run you into some dollars. But you don't really need a live tick feed all the time, and I'm betting that even with a live tick feed, that during these periods of high volatility, even that tick feed is going to drop information, because even when I compared the Schwab feed or the Tasty feed, and then I take the information that they're feeding me and then compare it to the actual 1 minute candle that they build, then it never matches that 1 minute candle that was built from the information, because you're not getting all the information gets lost, and that's just a fact of life. But I'm getting 97% of the information, and so 97% of 100, you're and when you're talking about the volumes that we're dealing with, that little variance is not going to make a huge difference on what we're trying to achieve. You don't have to have absolute, you'll never have absolute information. So it's just, how can I manage the information that I am getting to get the most out of it? And that's what adding that second feed is kind of, it's the path, of getting more confidence in the information, because now I have two sources. They're going to have their issues, but even with those issues, I'm going to get some alignment, and with that alignment, that gives you your confidence. And with that confidence, you can start saying, okay, this is how I can go into the trade. And I have a certain degree of confidence going on that the information I'm getting is clean enough to execute the trades. We're not quite getting to trade execution, but we're getting to the point where I can start tracking potential trade executions, and then starting getting some metrics against that and refining it and seeing what else can help refine the confidence level. Okay, so the big change is that all the information that was up here, I have now moved most of it. So this is all related to the real-time actions going on and related to the real-time action with the charts and stuff. So if I click this button, it will bring this to the latest point, because it will still run off the edge if you're not paying attention, or you step away from the desk for a little bit and you come back from lunch. All you have to do is click the button. It brings you to the latest section, and then you can adjust out. We're not getting any kind of live data feed, because the markets are closed at this point. And you can see when these go to double dashes, it means I'm in an after hours market, or we're in the downtime. And so that's why I had the red light going for both of them. And I can switch between the Tasty feed or the Schwab feed. Right now, just for while I am working out all the kinks, Schwab has the red-green candles, and they're slightly a different red and different green on the live candles. And when I go to Tasty, I get the blue and purple. Blue is for green, because the color for blue has green in it. Just kind of to kind of keep track and kind of keep the family straight. And purple is red and blue combined, but it's red. It has red in it, so this is the red candle. And these are the footprints make a big change. And all of this information is coming from Charles Schwab. These are all the 1 minute canonicals that I'm keeping as the source of record is going to be Charles Schwab on the 1 minutes, because Charles Schwab on the 1 minutes also provides data volume, the volume that you get down here. While the Tasty feed, I get the exact same information up here. I don't get volume on the Tasty. When you request candle information, it does not provide you with the volume for that candle. I am not sure within the application how Tasty handles it, but they may be using other internal feeds that they make accessible for themselves and don't provide it in the API. But that's what it is. So one of the other things with the changes that I made this week, as we go through the day, we have the imbalances, whether it's sell side or buy side, and so I've started putting an emphasis on. So some of the initial research that I've been doing has been coming back, and there's definitely a there for making trade decisions with imbalances and footprints and how they interact with each other. So an imbalance for me, we're dealing with short time frames for these imbalances. And those imbalances can stay for longer time frames and stay there for days or weeks. And I think they'll be almost as valid in these longer time frames, but they're really valid in these short time frames. And we'll go through an example later on. I took a screenshot of one that I did a trade with, because after doing some of the analysis, and we'll look at the analysis reports here, that when you start getting close to an imbalance, you almost always get a reaction. So we'll go through how an imbalance is formed. So we have this green candle here. We go into a change of direction. And with this change of direction, if this red candle exceeds roughly 1.5 times the size of the original candle, then I'm considering that an imbalance. So now here we have roughly a 10-point move. And then here we have nearly a 20-point move. So it's nearly 20 points. So this will trigger an imbalance. And then I will wait, and if the next candle we still have continuation in the direction, the downward move, then the imbalance grows. And for this one, the next candle continued the continuation, so the imbalance grew some more. And then we had a final candle come down. So the imbalance area was here, but we still want to go one more candle for imbalance. And here's our first go back into the balance that was created, the imbalance that was created. And then it pulls back. So this is really, I would consider this the beginning of the imbalance. So I have an imbalance area from here all the way down to here. Now the next candle immediately went into it. This candle, if we start going all the way back, then what we're looking for is not going to be here. But what we are looking for actually kind of shows up, and that while it did come in, it reacted back down. The next one we kind of opened up and went back down away from this imbalance area. So now now we have the hint that we want to go back into the imbalance area, but it was not ready to. And then on this third candle, it actually started going in. And since this one stopped here, we didn't get into testing the imbalance area until here. And what happens every time, well, not every time, it happens over 75% of the time we get a reaction, and that reaction is a pullback from that imbalance area. You make contact with it, and it pulls back. Since this first contact happened, so I'm tagging these as contacts. So I guess when this imbalance was forming, this candle wasn't great enough, and so I counted this as a contact into an imbalance zone. But then we generated another imbalance zone on the next candle, and then these are challenging into this imbalance zone. So I guess we have an imbalance zone right here, and what it did pull back, but it looks like at the same time of it hitting it closed out or came close to closing out the imbalance and pulled back. This is all, since I'm not watching this real time and just looking at what I have marked on it, this is what I'm trying to walk through the stages. So we did get a pullback, and we'll go through on the reports of what these pullbacks are, but usually the pullback is about half an ATR on the 30-minute. For a majority of the time, we can expect to get a half an ATR pullback. And so that basically closed out that imbalance area that was formed, because I'm seeing with this when we went back up into it. And so this imbalance area really started forming here. So we've closed out this imbalance areas that was formed here. So we have two imbalance areas that we're actually working with. So after this closed out, pulled back, it went up into the second imbalance area. And so this is the second time this imbalance area has been tested, because we got marked here for a first contact on the imbalance area. And with the research I've been doing, the second contact in the imbalance area, while it's not as probable as the first contact into an imbalance area, it too will pull back, and it pulls back, instead of like 75% of the time, it pulls back 70% of the time. So it's still strong, So that first and second pullback, contact with the imbalance area usually generates a pullback. Now that pullback is going to be weaker than the first pullback, but there is a pullback. And so this will go into making your trading decisions later on down the road, is that I'm expecting 0.5 ATR, and so that's what I'm going to set. Well, the second one is not going to be 0.5 that I'm expecting. I'm going to set it maybe to 0.4 of the ATR. Now, and that gets into the point that, well, ATR has to be above a certain range, otherwise 0.4 of an ATR may not be enough for you to manage your risk with, my risk return, that I'm willing to do, because it could continue and blow through instead of pulling back. That's the other thing. So we call that continuation. So instead of pulling back, it just continues on, and that's another scenario I'm working on. But that's going to take some additional research that we're working on. But the first one is that initial pullback after the contact. That signal is so strong that's one I'm going to implement. And so we're in the stages of gathering more information and trying to determine rules to where we can semi have it all structured out to say, this is what I'm going to do, this is what I'm going to expect to return, this is my risk, and we'll go from there. And that we'll go later on in the reports that I've been building for research. That kind of goes in. That's going to help set the basis of the rules that we're going to be making for this trade. And this one you can see, so we went into a third contact with it. And then we had a smaller pullback, but then it really never got back in above this high and eventually fell before it built. And on this green candle, we actually closed the original imbalance area that was created. And on this one, you can see after you went into closing it did fall back again. And that's what you'll see a lot of the times with these imbalance areas. You'll get a surge, and it will close it out, but then it will fall back. Now it's going to start looking for a new balance. But we're at the end of the day, and we're hitting that point where at the end of the day, the market's closed at 1 Eastern in the futures, and you're going to get to the point where we've got to close out the day. And so a lot of accounts that are just in for the day trade, when you get into the last 10 minutes, that's kind of like the bookkeeping hour where people start closing out their positions. And since we were, I think, generally up today in the trend, it really trends sideways for most of the day. The people that were in for daytime only, they were getting out, because we're going into what's essentially a 2.5 day weekend on the futures. It's a 3 day weekend for stocks, but there's a longer weekend, and so you have the sell-off as people closed out. And with this sell-off, we did generate a sell. So this one this candle's greater than 1.5 times as the previous candle. So this is what's triggering the rule. So the rule is just 1.5 times. It's easy to imagine it being a green candle and you have a reversing direction, but you can also have an imbalance of selling just because you're exceeding 1.5 times the previous candle. And we did have immediately buy back into the range, or it sold down but immediately went back into the range and tested but closed out. So come Sunday night, I expect when we open up, it's going to immediately move up. We may even gap up above here and close this out. That's just, or if it gets up too high, then it's going to come down and probably jump through that and close that range down on the open come Sunday. So that's kind of a lot of the things that we've been working towards the past couple of weeks. Just the data feeds getting delayed because of the volatility. It's been good and bad. I've now got 2 data feeds, and with that, I'm realizing that I'm getting more information, and overall, the net benefit is that with more information, I can make more informed decisions going forward, and I have a fallback. So if one system goes down, I have the other, and because these data feeds are slightly different, it opens up more avenues of getting either confirmation with a different method, or I have access to different types of information, since not every broker provides the same information. So I can accumulate different feeds and pick information that's not offered from other services, and then we can include that all in this and have something that's better than just going with a single data service provider. Okay, so I believe last week I may have shown this imbalance report, and what we'd found in doing our work. Let's see. Let me go in here. So we'll go to the first week of June. We're not going to do multi-week analysis. So we'll go through some of the features that I added in this week. I'm going to run the report real quick. So I'm impressed with the layout or the setups that I've been able to do with having a local database, and then the Java web server. It's a simple web service. I'm not using a web application framework. Because that's like overcomplicating. This is not going to be something that's going to be set up on a website and sold. This is for personal consumption, because I'm not paying for these data feeds. So when you agree to everything, you can't sell the data feed off to somebody else. You can only use it for personal consumption, and that's what we're doing here. Just showing you how easy it is to do your own data feeds. Okay, so this is for the first week of June. So it's like for May 31st, which was a Sunday, and it's the first week of June. And this is what got me, once I built this report, this is what got me saying, we've got something here with the footprints. I thought we had something, because I've seen stuff out there and it looks like it works. It's just like, I want to validate it. I don't want to go from somebody's word that, trust me, this trade thing is great and it will make you money and all that. You don't know. And people don't tell you everything because they're trying to sell you something for the most part. This, I'm just trying to learn and share my learning as I go. So there's nothing being sold here. It's just showing that you too can now do stuff if you want to with an AI agent, and you don't have to pay somebody else. You can create the work yourself, use it, and it's all on you. You can't blame somebody else either, but it is yours. So what was standing out is that, so this report is taking the imbalance areas and then looking for a footprint flip. And I think I've explained a footprint flip, but what it is that I will have, I don't know if we have one here. Yeah, we do. We do have flip. So flips are fairly common. If we look here, any associated flip. So this is any flip in general. Flips happen all the time with the footprint. You have, what a flip is that you have like a red candle but green delta. So price went up, and that's why you have the green candle, but you had more sellers than buyers, and so that's what the red delta is. And so when you have a difference between candle direction and your net buyers and sellers, when they don't agree, that's usually a flip. And what we usually want from these flips is that we have a downward candle, red, so negative delta. So that means, yeah, the red candle, and there are more sellers. And so we're getting confirmation with the delta saying that, yes, price went down and there were more sellers than buyers. And then the next candle, it's red. Price went down. We look down here, it's red. So we had still more sellers than buyers. Now here we're getting some action. It went up, but it also continued down. And when we look down here, we still had more sellers than buyers. It's a little bit less, so it's 70, 70, now 30. So we're getting a slowdown in buyers. That slowdown really doesn't mean anything yet, but it's just it's a signal. And if I look at the times, let's see, it's 12:53. So if I look at 12:53, so we're on this candle area. So these falls right here are corresponding with these candles. So we definitely have selling happening within these candles. Okay, so here we go to the fourth candle in a row, and this one's red, but if I go down, I've got a green delta. So that means there's actually, even though price went down, there were more buyers than sellers at this point. So that way you know that you're entering or about to enter a change. So we have more buyers than sellers. And that's what we're looking for. So this is a flip. And what we found is that if I have a flip and I'm entering into a sell zone, which are not here, so this is not the pattern that I'm looking for. This is just a general pattern that I have a flip, and when we have a flip, you usually get a change in direction. But it's like, how often? What does it mean? Do I always get the change in direction? And the answer is no. And that's what that's why we collect all the data, and that's what we're doing the analysis for. And so, in general, if I take any kind of flip, what I will see is that half the time it fails. So a flip by itself doesn't mean anything. So a flip, it's still a 50-50 coin flip. So when you look at a chart, the basic odds is that, okay, I've got a green candle here. Well, the odds the next one's going to be red. Well, it's basically 50-50. People will argue, well, you've got that unchanged chance. And unchanged does happen, but more often than not, that's less than 1%. So you're still looking at 50-50 if you round it. So I have a green candle. The next one, Is it going to be green or red? It's 50-50. That's why even if you do your option selling, that's why that delta's 50 at the money, because the direction it's going to go, it's 50-50, whether it's going to go up or down. And that's the same thing for every candle. Every candle is 50-50. It's just that, well, we know from history that you can get trends. Here's a trend. But eventually that trend ends and you go down. And look, if I look overall, it's still unchanged. So it was 50-50 on its move, And that's, but how do we know that if it's red, what's the odds of it going to be red again? Red. We don't know. But if we start looking at history and looking at series of candles and setting up conditions for these candles, then what happens? And so that's what this imbalance report is. So this tells you exactly what you're expecting, is that 50% of the time it's going to go the other direction. So I'm getting a flip. So it flips, so it must be changing direction. Not necessarily. Half the time that flip doesn't mean anything. It just means that at that point in time you did have more buyers than sellers, but the next candle after that invalidated it, half the time. So the next footprint invalidated that flip. And so then you would call that a continuation. And so now I started looking at qualified flips. So a qualified flip is that I had two candles or more. And this one we had 1, 2, 3 candles. So my qualification is that it has to be 2 to 5 candles before the flip. And then with the flip, I should get a reversal. That's what we're looking for. And if we look on that, you get 48%. So it's a slight improvement. So even saying I've qualified the flip, I have to have 2 to 5 candles prior to a flip. That even after the flip, it's still, it's shifted, 51% of the time it continues basically the other way. Now, only 48% of the time does it continue that way. Well, what else can I add? Well, the next thing we added was the imbalances. So when I have an imbalanced area and I'm trending into it with a qualified flip and I get a flip, what happens? And this is where everything changed. So I have a movement in to a qualified flip. So we're moving into an area of imbalance. And then I get a flip. What happens? Well, if it's the first contact, 62% of the time on this week, on the first week of June, I had a reaction on moving 15 points. So this is telling me that I hit an area, I got a reaction, I got a pullback of 15 points, 60% of the time. All of a sudden, we've gone from some kind of 50% of the time it happens, 48% of the time it happens when I qualified it. Now, 30% of the time it fails. So that's telling me almost 70% of the time that I get the flip, it reverses. And out of that 70% of the time, 62% of those reversals went 15 points or more. And then nearly half the time they go 30 points or more. And so now I've got something. This is what we've been looking at. Otherwise, it's a coin flip on your trade. And some of the other stuff I'm looking at, it's like 60% of the time it may happen. Now we found something that is 70% of the time it was happening this week. And not only that, 62% of the time of those flips went for 15 points. Now I can say, okay, I can risk a 5-point move to get a 15-point move. That's a 3-to-1. Or I can set my thing as like my max losses will be 10 points, but my goal is to get that 15-point move. And so I'm at 1.5 to 1. So this is where you're starting to define your risk, because I'm going into a zone where I've got the flip. I'm expecting reversal of 15 points off of that flip. This is not a condition right here. But we just kind of go through the thing. We're going through these footprints going down, and then if I was hitting an unbalanced area, we're not hitting an unbalanced area in this one, but if we were hitting an unbalanced area, then I would expect a reversal for 15 points. And then half the time it could go up to 30 points on the reversal. That week was fairly volatile, and it is the NASDAQ, and 10 points in the NASDAQ doesn't mean as much because we're dealing with 30,000 points. So 10 points on the NASDAQ is not even, it's a fraction of a percentage. It's not even a tenth. It's like 0.3%. And so that's very doable. Over a span of 10 minutes, you can get this kind of move easy in the NASDAQ, because look at all the 10-point moves here. So 10, 20, 30, 40, 50. Our range is 50 points of movement. It just may not be 50 points all at once, but over a short amount of time, we're talking about less than an hour, you're getting 50 points of movement. And all we're trying to do is get 10, 15, depending on, this is where ATR is going to come in later. So, because the reason why I just did 15 and 30, I just wanted to come out with some kind of numbers. But this is where we started getting at. I put in a few conditions now, and 70% of the time, this failure of the first. So so the failure means it's not really a failure. It's just, the way AI comes out with things is that if I set up, this is what I expect the outcome to be. If it doesn't achieve that outcome, then it's a failure. In trading, it's not a failure. It just may mean that instead of my assumption being wrong, it's just an assumption that all those conditions are met. It's just where I thought I should go one way, it actually goes the other. And so instead of being a buy, it becomes a sell. Or if it was a sell, it becomes a buy. So even though it says it fails a third of the time, actually you're successful 70% of the time. So it's just interpreting how the AI built the report. Once I'm happy with everything, I'm going to start rewording everything correctly. But for now, this is what I want out of it. That I'm getting good information. And since we are failing 29% of the time, this is the opposite of this. And this would be what we'd call continuation. So I moved into that zone, but I continued moving through it. But what we can see is that a fifth of the time, I do pull back 15 points. So even though it continues, there is a small fraction of the time that even if it's a continuance, I'm going to get a 15-point pullback from that first contact. And so that's some of the stuff I'm working on right now, is that how can I set up, can I know that I'm going to get a continuance before hitting that contact, so I don't ever get into the trade. And by not getting into the trade here, that I then boost my winning success. Instead of it being 70% of the time, we bump it up another 10%, just because there are some things that I can say that when I get this, I have higher odds that it's going to be a continuation versus a pullback that's strong enough that gives me my 15 points this many times. So that's what the focus is on. But I'm going to start implementing next week of putting this signal into the chart itself, to where when we are approaching a zone and the footprints are qualifying, and that this is starting to flash green, even though the candle's red, this is flashing green, it just hasn't closed out, then we'll still put an alert on the current forming candle that we have a potential for a trade, and then I can set the trade on my trading platform. And it's dependent on these being close enough in real time that you can set up trades. And I'm sure as I get more comfortable with it, that I will already see the potential for that trade, and I know that as we're moving into it, that I can go ahead and pre-set up the trade. And it's just that we'll look at this as it's forming, and hopefully later on we'll get the ABC type trade. So is it a strong trade signal? Is it a medium trade signal? Or is it a weak trade signal? And if I don't feel like it, you don't take the trade on the weaker signals, because the weaker signals mean a higher probability of failure and a lower return as well on the trade. Okay, so what we did this week, I had this report generated last week, and I think I showed it to you. What we added is that to do multi-week analysis, so I can click that. I can have multiple weeks, so we can clear the weeks here. So I've set the futures week here. So this is the first week of June. I can add that in, and then I can go to the next week of June, build that week, and I can add that week. And now I can run the report across the 2 weeks and get a consolidated look of 2 weeks of data. Because, see, are we done? No, it's still running. So with this pink circle, I know that the report's running, and it should change the status up here once it's completed. Yeah, okay. So we have, over a 2-week period, we have nearly 800 contact rows. So this is 800 times where a candle went back and made contact with an imbalanced area. So that's one of the things, one of the guys I've been watching, he does something similar, but he looks at higher time frames, so he comes up with less areas, but they may be, the really strong areas. And I'm looking at, I'd rather have a higher number of occurrences. I may not be 80 or 90% successful, but at a 70% success rate, and instead of having 1 or 2 a day, I'm having 10 a day, then I will take smaller wins, more losses, if I'm having more instances of it, because then I should net out at a higher rate than focusing on 2 or 3 possible trades a day. Okay, so we'll go back. So we have nearly 800 instances, and with this we had 102 over a 2-week period, and so that's 10 days. So it's, what is that? 10 divided by 10. So that's 10 occurrences a day that I had something. And the first contact, 75% of the time over that 2-week period, we hit 15 points taken. Now we haven't started working in, how many times did I get, as we get, I've built the data. Now we're going to start analyzing trade scenarios. So even though I hit this 75% of the time, you got the 15 points. How many times did I get stopped out? You know, that's going to be the next things we start building, because I'm pretty confident that I want to use the signal. But now we got to do the next step is to quantify how many times do you get stopped out of that trade. And these are some of the stats. So we have 102. That 102 falls into this line right here. And 83% of the time over those 102, we hit the 15 points. And 2/3 of the time you hit 30 points. Okay. I added ATR, so 75% of the time you hit 0.5 ATR. So whatever ATR is, so you see that it's a little bit less than this 83. ATR was greater than 15. That's so it was between 15 and 30. But 0.5, you hit that 70%. In the full ATR, the average trade range, you hit it 60% of the time. So that's telling me that the average trade range was a little bit more than 30 over this 2-week time period. The average ATR. So it's been volatile the past few weeks. I think ATR will hover around 20 on an average week during certain points of the day, like the morning. And as you get closer to the end of the day, it goes down to like 10 until that last hour, then it may spike up again. Okay, so this is a bunch of data that we're collecting and doing the analysis with, and seeing how it plays out. And then I have all of the these are just all the different ways to look at the data that we're getting. So I'm looking at footprint size. So was the delta a double digit? An extreme 1,000 point delta, because we've had some 1,000 point delta days on where the buyers or the sellers, doesn't matter, because it's these news events, you'll end up with an extreme. And then single digits, it's like these deltas, it could have been negative, it could have been positive. We get down to single digits, because you're talking about a handful of contracts went one way or another off of a 60-point move. And then there's triple digit. And what we've been finding is that the double digit overall hits at a higher rate than if I was just looking at, we're looking at flips, but if I take the flips and break it down, so if we look up here and we have the reaction and the ATR was at 80% for 0.5. Well, if I look at, was my delta a double digit delta, my 0.85 ATR was actually 83%. And it was at 183, so the majority of it. But what you're seeing also is that on triple digit deltas, I didn't always really hit ATR at a greater rate. So this is what pulled it down. So even though this was almost as great as the double digit at the flip, what we're finding is that a double digit flip actually hits my target more often than a triple digit flip. So you think, okay, the bigger the flip number on the delta, is that the bigger reaction that you're going to get. Well, what's happening is that the reaction is not bigger, and it may have been just a very, very short imbalance time before you actually hit continuation. And so I really didn't hit ATR, my target range. I hit it less often than what we were thinking of than with the double digit. So this is how we're going to use the history and getting the metrics built in to have the confidence that I am more likely on a double digit flip. I want to enter it. I may weight heavier entering in on double digit flip versus a triple digit flip. So that's how you manage your risk. So on this one, I may sell 10 contracts, and on this one, I'll sell 5. You know, I won't trade at all on 1,000. You know, you've hit extreme volatility when you're like that. So you don't know, those are times when you don't want to get in a trade. It only happened 9 times over a 2-week period. But it's also another thing. It's like you hit this is something that you're not going to trade on. And then on the single digit flips, it's even worse than the triple digit flips. And so that is the weakest point. So this would be your A trade. This would be a B trade. This would be a C trade if you take that trade at all. You know, because my full ATR, less than half the time to achieve it, and on the triple digit, less the time you achieve it. But here, this is why you want to rate. You want to rank these trades, and this is how you do it. You're breaking down, and the only way you can start breaking down is that you have enough counts, enough data. That's why I've been saying, I'm waiting for the data. Well, the data is starting to build up to the point where we can build the confidence, and so now, as we get closer and closer to actually placing the trades, I may set up, sell 10, but 5 will be at the 0.5, and the other 5 may be up here at the 1, or I'll weight it. It may be 6 or 7 at the 0.5, and then the remaining 3 at the 1. So I will get more than if I did this, and I'll get a little bit even more if we hit this, and this is saying, almost 2/3 of the time you get the full ATR. And if ATR at that point is 20, I'm getting 10 points on the NQ on most of my stuff, and then I'm getting an additional 10. So it'd be the equivalent the payout would be the equivalent if you weighed it out correctly. I can risk 10 and get paid out as if I had risked 15. 15 and get out here, or 10 spread out where I'm waiting here more and a little bit more here, and I get the equivalent of 15 out of that 10. That's, so that way you're managing your risk. There's 2 ways to manage risk. It's size and time, size, time, distance, and the way I can get a higher return out of the same amount of capital that I'm risking. Okay, so here we're looking at ATRs and looking at how it came out on the ATRs. And I don't think I have to find ranges yet. I just let the AI do a low, high, extreme, normal ATR. But you can see that a normal ATR and the low ATRs, you hit that 0.5 ATR more often, but it's low ATR. So I'm already at a compressed, and I haven't worked out the details yet of what is in the low ATR and determining, is it even worth making the trade? Because I hit that 0.5, is that 0.5 worth enough for the risk that we're putting in, or does the risk is so small, or the risk that you have to put up gets challenged, or you don't complete the trade because you got taken out of the trade because you hit your risk level. So this is, as we get closer and closer to building the trade, this is the information we'll be using to look at it. But you can see that even the delta plays role significantly. The kind of ATR, so how volatile it is, has a role into it. When you're in extremes, this is just telling you that even at the extremes of getting in, you're not going to hit, more than likely, because you only hit 1/3 of the time the full ATR. The ATR could be 50, but you only hit on the trade 1/3 of the time that 50 points, and so it's like it's not worth the trade. You're seeing as volatility goes up, with this specific trade, it's not very good. It's for regular volatility, regular trading. What I'm considering is that we're in a lot of algorithmic trading right now, and you can see that in the charts. Is that algorithmic trading is that you start hitting these trend lines, and you respect these are all the EMAs that we've added. So we know that here we are, we're bouncing. I break through it, and when I come back, I'm respecting the trend lines. We broke, it came up, we challenged through it, but it came back down. Here we go, we hit, and it comes back down. It comes back down, comes back down. Now we break up above it, but now we're breaking back down below it. And as we break down, we're hitting that trend line. And you can see here, you had a bounce, we went below it, closed above it. Even though it went down, it went below that trend line, but closed above it. Then we broke through. But we didn't even get down to the next trend line there. This is the 21 EMA on the 15 period. But even though we didn't go down, you saw that it started respecting hitting that 15 for a while and then came back up above. But it didn't go far enough, and as it came back, it bounces off. You see it bounce. And it is a trash area because you got all of these so close together. And it just shows you that you're just really in a balancing area. And you can see that's why we had, even though we created imbalances at the extremes, it closed out the imbalances and just kind of meandered. This is also the end of the day. It's a light day. But this is how you know when you're in it, when it's really being controlled by the algos. There's not a lot of emotional, there's not a lot of news changing things. And when that happens, it just kind of drifts. It doesn't drift too far away from these trend lines. That's because the algorithms, it's like, well, we got too far away. So now you start getting sell pressure until it actually starts hitting trend lines. Now buy pressure comes back in. And it's in this environment, as long as the ATR is wide enough that we're moving in, that this trade is going to do its max payouts. And we're just trying to collect the information. So one of the other things that I'm looking at is what time of day do these trades happen. And you can see a lot happens in the overnight. Well, the overnight's 2/3 of a day. So you would expect to have more overnight interactions with the imbalances because it doesn't take much to push things around. And even though things do get pushed around, they will come back and try to close those imbalances. So this may be something that, for overnight, I may consider, putting on. But what I'm really starting to see is that pre-market, before we open up for the day, is that we're hitting that ATR a lot. And it's a clean hit. So clean means I hit the imbalance zone, it pulled away quick and didn't meander around that initial contact point before pulling away. So not quite half, but it happens enough that it's a clean, I get my point. I get my ATR here, half an ATR. And half the time it's choppy. So between these two, and that gets you your 85. Let's see, 7, 10, 80. So 80, that gets you 80% of the time that when you hit it, it may chop around a little bit, but then it pulls back. So instead of taking 1 minute or less, it may take 2 or 3 minutes. This is pre-market. And we have a larger percentage of all the trades that happen out of those 102. Because all of this is totally built on this bucket right here. Because this is what I'm truly analyzing now on the aligned qualified flip. We're wanting to get the details of what does it mean when I'm hitting that. So another thing that we're looking at is how are the EMAs looking at the time of the flip, and does that play a part? And there's only 2 uncompressed, so you have to throw that out. There's not enough instances. But if I'm in a bear trend and I get the flip, then 84% of the time we hit the ATR. So these are just weightings. We'll have to work later on to see how well, but this is giving that if we are in a trend environment and we get the reaction, that whatever I'm looking for on the reaction, when they're in a certain configuration, we do hit a larger percentage of the time. Because if there wasn't a correlation, then we would expect like a 50-50 on this. So this is just all the data that we're building out to where we can start making decisions and saying that when these things line up, this is what I can expect. So one of the other things is that when I hit an imbalanced zone, how many times do we go beyond the zone? So we go all the way through. How many times do we make contact with the zone and we go into it? Do we get the pullback? Did we go halfway? Did we go all the way through? Did we go beyond? Did I go in? I don't have details right now for what's a normal penetration and a shallow contact. Shallow contact means you barely went into it. But, shallow contact also means that I get a clean break back on the reaction coming out. And even if it's choppy, and we're hitting 80% of the time. So knowing that 80% here, 80% here, 80% in the pre-market. So when all these things line up in the pre-market, I am pushing, 80%. If these 3 things line up, then I'm probably going to have a higher probability of the trade going through. And so that's what we're looking for. This is right now we're just collecting the data, and I'm starting to break things out. And as these counts go up, as we add more and more weeks, then your confidence goes up that this is what really happens in these combinations. So we'll start looking at combinations of everything to say that when I hit these 5 things, then I can have this trade and I can be 80% confident that it's going to hit. And when you get that 80% confidence, then you can start increasing what you're putting into that trade because of your confidence level. That's how you start weighting your trades. I'm less confident in this trade. We're hitting these same conditions, except they're not the perfect conditions. And so it's not the A trade, it's the B trade. And so that's why you size your trade accordingly to the type of conditions that you're hitting. Okay, and what I also started this week at the end is that we're going to compare the Schwab and Tasty feeds to each other. So I'm getting signals from the Schwab way, I'm getting signals from the Tasty way. And since the way we calculate with them are slightly different, we want to know at those difference points what's reporting the same both ways and what is slightly different on those. So where I can start getting a, if you get, it's like saying, 3 out of 5 are saying this, then you have a higher confidence level that 85% I was talking about on the other stuff is even higher because I'm looking at it 2 different ways for that. So the big difference is on the deltas. So in the areas where we have the differences, So if I look here, the deltas with Tasty are smaller because they're more accurate, because I'm getting two updates per second, and those updates are broken out with a random sampling. I'm going to call it a random sampling. I'm sure there's logic on what generates that sampling, but roughly, I know if there were 1,000 contracts trading in this 60 bar, I get the information on 100 of those cells. And with those 100 cells, I know exactly how many buyers and sellers. So I'm getting roughly a 10% sample rate of the overall. And then I know the exact mix of the buyers and sellers of 10% of that. And then I'm just going back and saying, well, if I know this 10%, it's just projected out to the 100%. Well, on the Schwab feed, I'm just getting roughly 100%, but I'm just given a price. There's a bid and an ask range, and then I may get either bid, ask, or something in between. And that something in between is usually halfway exactly in between the bid and the ask. And it will say like the average price was this. So the average price is either the bid, the ask, or halfway. And based on that, I'm going, okay, so for this second, it's either 100% this way, 100% that way, or 50-50. And so I put it as a 0 for the delta on that. And so the Schwab, I know, is overstating the delta. It's just that what we're finding is that even though it's overstated, the direction is correct on both of them. And so that's what we're starting to analyze, the difference between the Schwab and Tasty, that even though there's differences, and Tasty's usually a smaller, I consider Tasty to be more precise on the delta, because we're estimating delta, because I don't have a true tick feed, so I don't have a true delta, but we're trying to work into an estimated delta. And the Schwab will overstate, and the Tasty trade will be closer to what probably is the true delta, because I am given a mix, at least, of the deltas, of the buyers and sellers, and so I am getting a more accurate delta extrapolation out of that versus the Schwab one. But what we're finding is that I'm matching up 90% of the volume between the two, and then 75%, if I look at absolute delta direction, we're in agreement for most of the stuff. This one is I'm still working with all this. Is a new report that got generated basically today, and so this is like first go around with it. So I don't have all the ins and outs yet of this, but what we're finding is that I'm getting agreement. It's just that the agreement may not be, there's going to be differences, where Schwab records it as a triple digit delta. Tasty may be doing it as a double digit delta. And if that's true, that just will go back and reinforce that double digit deltas, if they're hitting, they may be hitting even higher than what the Schwab stuff is doing. And so it may be that I get a bigger difference between double and triple. And what we're finding is that the extremes are the extremes. It's just that I don't get as many extreme readings with the Tasty, because I'm getting a breakdown. Because for there are buyers and sellers even when there's so I don't get this 1,000 point extreme. I get something else different, but we haven't dug in, and I've only got 1 week's worth of good data with Tasty. So this is stuff that's we'll be building out in the future as we get more data, and with more data it helps just refine everything that we're working on. But we're getting to the point where I want to get this on, start showing at least this on to the chart to where I can start making trades. They're all going to be manual trades at this point, and I'm going to just I may go for the raw 15, or I may go, one of the things I did add, we just can't see it because it's not live, is that I will get the ATR ranges are already displaying on the live candle. So I know when I go into a trade, I know where 1 ATR is, and I can ballpark the 0.5 ATR and set my trades on my trading platform based on that. Okay, I think we're going to go to the last thing I wanted to share for this week. Yeah, there's actually some stuff to share this week. Okay, let me bring that up on my screen to where I can look at it. Okay, so this is something I took in pre-market right before the market opened, and I made this trade. And this is a picture of the imbalances. So I have an imbalance here. It was down in this area, and this candle created an imbalance on the buy side. So we had a buy imbalance and a sell imbalance, and they're really close to each other. So we have 10, 20, 30 points, and at one point it was really just 10 points away from each other. So when this happens, there's going to be a bounce. You can end up with you could call it boomeranging. It's going to go from one imbalance area, go down to the other imbalance area, because it's just collecting liquidity. And sometimes when things barcode, you go, why is it barcoding? And these were really, you can see with these big shadows, is that it was liquidity grabs. It was like, okay, I'm grabbing liquidity and falling back. And then it falls down and grabs liquidity, because this liquidity, we started up all the way up to here. And then we had your first contact, and then later on, this first contact ran liquidity down to this level. And then this contact ran liquidity down to this level on this. So I saw this morning, and I actually put in a trade entry at this point. Probably the worst point to put in a trade. But my assumption was we had just created this. I didn't think we'd be coming back to it soon, and I still had this liquidity level up here. That usually when you get down to this point, it wants to close it out. Because we had 5 points, and so I'm looking at a 10-point move at least just to hit this area. But I have this down here, and with the research we've been doing, 3/4 of the time I'm going to get a reaction if I hit. So I know that even though I'm getting here right in the middle, the worst part, I'm looking at a 10-point run. That was my goal. But I sold 5 contracts because it's pre-market, and I'm just testing things out. So we're doing 5 micros, so not even a half a mini. So that's how you control your risk. So it started falling, and I thought, okay, I've got this liquidity area down here that I could get a reaction on. So, and I've got the EMA coming up. So there's going to be, if we respect the EMA like we've been respecting it prior, then odds are I'm going to get a bounce here. And that bounce also coincides with being in a liquidity area, an imbalance. So knowing that we've been respecting this trend line coming up, seeing that I've got an imbalance, that I could put an additional buy right here. So I bought here 5, and I said, well, we'll double it up. I'll put another 5 here, so that will reduce my cost. And so then I can go from a 10-point to a 15-point. And so I'm risking 10 to make 15. And I decided, instead of having my sell up here above, or near the top of this to close out, that I just put the sell right here for the 10, right before we got into the liquidity area. And so, as you can see, we did hit even And that's why I took the screenshot. So I made the trade and I got in and got taken out right here. And even though that's not the trade I'm looking for that we're building right now, this is kind of a byproduct of an example of a trade that you could take advantage of just by having the stuff on the chart and understanding that when I hit this, 75% of the time I get a reaction. It's just, I know I'm going to get a reaction. It's just like, but it's a 50-50, but I have things waiting in. And you can see the ATR numbers that I have. So the ATR was roughly 16 points. So when it hit here, I got the full ATR that we were expecting for the candle ranges. So it's, it kind of gives you a good feeling that this work is paying off, not just on looking for a specific trade. It's like, well, here's a generic trade, but I saw the conditions were setting up that we could start tapping between these liquidity levels, these imbalances. So it found an imbalance, closed it out. And what it actually did is it continued. It actually went down. I think it closed out this and then came up again and closed this out. Because I think we went up all the way to 3,700 and then played around. So this is pre-market, and when the market opened up, it closed out all of these. Because it's looking and sweeping all the liquidity. So this is just a pre-market. But the pre-market we're seeing is that, it's hitting some 85% ranges for half the ATR. And so I may be focusing on some pre-market trades with this, along with don't do anything during the first hour, and then looking at post first hour, using it for trades. So that's all I wanted to end up with this week, just sharing, how it's paying off dividends on other things besides looking for this one trade idea that we're going to work and try to take it all the way to completion of, like, this is going to be an ongoing trade and continue looking. And maybe this is something that we study and see how often do we end up with imbalances like this, and then we end up with swings between these imbalances and what can be done. So this is just seeing things, taking advantage of it, and now that I've had a positive outcome, it's like, well, how often does this happen? And then we're collecting data. That's what the whole point of the database and storing everything and setting up these imbalances programmatically. I'm not doing things by sight. It's all based on some rules. And so by having these basic rules in place, and then we see how we get the reactions to these areas and stuff, that we can start defining more programmatic rules to take advantage of this and maybe automate it. I don't know, because the market changes every week, and I'm not sure. As we get, the thing is, you have to have data, and data is what we're collecting and building. But we take the smaller wins, and we'll just add more and more types of trades that we could take advantage of, and having all this stuff built into a program, I don't have to mentally keep track of all the different kinds of combinations. We let the program keep track of it and alert you to what's coming up. And this is all done using an agent. So, and the agents are cheap. If I think on this trade that I did, I cleared like $300. And that pays for basically 3 months of Codex, the OpenAI Pro plan. So just one trade paid off for 3 months of Codex, and we've been developing for about 3 months. So I'm already at break even off of one single trade, and actually I've been making other trades based on what I've been learning. So it's already paying for itself. There's already an ROI on building this project. And that's why we're kind of sharing this, to where I can track it myself and see the improvements over time, and just to show that these AI agents help lower the bar of entry for you to get in and whatever you're doing, because the AI agents you can use across anything. And I'm just seeing the possibilities, and this is just one possibility of how people will be able to use AI agents to their benefit, for their own personal benefit, and not just being the proprietary of large institutions that used to employ whole dev teams and stuff to do what we're doing now. Okay, well, I hope everybody has a good weekend, and I will talk to you all next week.